In 1907, the American economy collapsed. The stock market fell by 50% in 3 weeks. Banks failed. People lost their life savings overnight. It was a time of absolute financial terror, a time that looks suspiciously like the headlines we are seeing right now in 2025. But in the middle of that chaos, a small book was published. It wasn't about how to survive. It was about how to get rich when everyone else is panicked. The book is called The Law of Financial Success. We think we are smarter today because we have algorithms and AI. But what if we aren't? I read this 100-year-old manifesto so you don't have to. And what I found wasn't just save your pennies. I found a psychological blueprint that explains exactly why most modern investors stay broke and the 5 lost laws you need to build wealth today. The premise. The author, Edward Beals, starts with a brutal truth that hurts to hear. He says, there is no such thing as luck. He argues that financial success is a result of a law, just like gravity. If you jump off a building, you fall. If you violate the laws of money, you go broke. It doesn't matter if you are a nice person, and it doesn't matter if you work hard. This is the first slap in the face for the modern worker. We are taught that hard work equals wealth. Beals wrote in 1907 that hard work without the correct mental attitude is just slavery. He breaks this law of success down into specific habits. Let's look at the first one, which completely contradicts how we think about risk today. Law number 1. The fear leak habit. Number 1 is closing the fear leak. Beals writes, worry is the most destructive force in the financial universe. Now, this sounds like magic, but let's look at the math. In 1907, during the panic, investors who operated on fear sold their stocks at the bottom. They tried to preserve what they had, and by doing so, they locked in their losses. Fast forward to 2025. When the S&P 500 dips by 10%, what do most people do? They stop their auto investments. They hoard cash. They wait for certainty. Beals argues that this worry paralyzes your ability to see opportunity. He calls worry a poison that literally destroys the brain's ability to plan. If you are constantly checking your portfolio app, stressing over every red day, you are not being responsible. You are actively destroying your financial future. The 1907 solution: detach. The successful investor in 1907 knew that the market is a cycle. Panic is temporary. If you can eliminate the emotion of fear, you become the person buying when everyone else is selling. This leads us to the second law, which explains why we are so bad at this. Quick reminder, if you're getting value from this video, take 2 seconds to hit the like button. It helps the YouTube algorithm show this to more people who need it. And if you're new here, subscribe to Simple Money Method so you never miss practical, jargon-free financial guidance. Law number 2, the mental standard of value. Law number 2 is about your mental standard of value. Beals asks a simple question. What is money to you? To the person destined to be poor, money is something to be spent. It represents a product, a car, a dinner, a vacation. To the person destined to be rich, money is something to be used. It represents a tool, an employee, a soldier, a seed. In 1907, there was no credit card debt. If you didn't have the money, you didn't buy it. Today, we have distorted our standard of value. We spend future money to buy depreciating assets. Beals argues that you must shift your money consciousness. You have to stop seeing a $1,000 iPhone as a phone. You have to start seeing it as $1,000 of capital that, if invested at 8% for 30 years, would be worth $10,000. Every time you spend, you aren't just losing the price tag. You are killing the future children that money would have produced. The 1907 habit is ruthless. Never spend the seed corn. Only spend the harvest. Law number 3, specialized ambition. This next law might make some of you angry. Modern finance tells us to diversify. Don't put all your eggs in one basket. But Beals argues for specialized ambition. He writes, the man who tries to do everything does nothing. In 1907, the titans of industry, Rockefeller, Carnegie, Morgan, didn't get rich by diversifying. They got rich by focusing intensely on one thing until they mastered it, and then they diversified to protect their wealth. How does this apply to us? We see 20-year-olds trying to day trade crypto, start a dropshipping store, and invest in real estate all at once. They are mediocre at all of them. The 1907 rule is concentrate. Focus your energy on increasing your primary income stream first. Be the best in your field. Maximize your cash flow. Then, take that surplus cash and put it into a boring, diversified investment. Remember this: concentration builds wealth. Diversification preserves it. Don't confuse the two. Law number 4. The principle of false economy. This is my favorite concept in the book. False economy. Beals warns against being cheap. There is a difference between being frugal and being cheap. False economy is trying to save money in ways that actually cost you more in the long run. It is buying the cheapest car that breaks down every month. It is skipping the dentist to save $100 only to pay $5,000 for a root canal later. It is buying cheap stocks because the share price is low rather than quality companies. In our modern dividend growth strategy, this is crucial. Many beginners chase yield traps, stocks paying 12% or 15% dividends. They think they are getting a deal. That is false economy. You are buying a rotting asset because it looks cheap. The 1907 rule is, quality is the best form of savings. It is better to pay a fair price for a great asset than a low price for a bad one. Law number 5. Willpower and autosuggestion. Finally, we come to the engine of the entire system: willpower. Beals talks extensively about autosuggestion. This was 30 years before Think and Grow Rich, but the message is the same. Your financial reality is a lagging indicator of your mental reality. If you tell yourself, "I can't afford that," or "investing is for rich people," your brain will subconsciously sabotage your efforts to prove you right. Beals suggests a habit that we would call affirmations today. But in 1907, it wasn't spiritual, it was practical. You must train your brain to expect success. Why? Because when you expect success, you recognize opportunity. When you expect failure, you only see risk. The will is the ability to stick to the plan when the world is burning down. In 1907, the people who had the willpower to hold their assets through the panic became the millionaires of the Roaring Twenties. Those who lacked willpower sold out and stayed poor. How to apply this? In 2025. So, how do we take these dusty rules from 1907 and apply them to our portfolio today? It comes down to a simple 3-step strategy. Number 1. Concentrate your effort. Stop trying to find the next Bitcoin. Focus on increasing your income skills. That is your engine. Number 2. Buy quality, not hype. Avoid false economy. Invest in the S&P 500 or high-quality dividend growth ETFs. Stop chasing cheap junk. Number 3. Close the fear leak. When the next recession hits, and it will, remember 1907. The panic is the opportunity. If you can control your fear, you win. Conclusion. Edward Beals wrote that financial success is not a mystery, it is a formula. The variables in the formula haven't changed in 100 years. Income plus discipline minus ego equals wealth. Society tries to complicate it to sell you products. They want you to trade, to borrow, to stress. Don't fall for it. Be boring, be disciplined, and be rich. If you want to build wealth the simple way, make sure to subscribe. Next week, we are looking at the crash of 1937 and why the charts look terrifyingly similar to today. You don't want to miss that one. Thanks for watching, and I'll see you in the next one.